Welcome to Insights. I'm Eric. Thanks for stopping by. We're going to talk about the economy and stock report, but we're going to put this one in a review. We're going to talk about some of the concepts that we've been addressing here lately. We restarted that one in November rather than waiting until January because of some of the important events that are unfolding inside the matrix. And we're going to keep this one open so everyone can look at it and maybe start to appreciate some of the things that are developing out there in the world. And it's really goes above and beyond what's taking place in the crypto collapse that everyone seems to be talking about, but are ignoring a lot of other important things that are taking place simultaneously or at least coincidentally. And I would say that many of these events are interconnected. There is nothing that exists. No market trades in a vacuum, and you will see that. And people who watch the Matrix and download it and watch any of these reviews and reports, they quickly start to learn that concept. But some of the things that we're going to talk about today are, does the Fed have inflation and the economy under control, and are things getting better, or where do we stand? And the things that we're going to address are concepts like the economic activity composites, which are found down in this section of the matrix. This is a full version of the matrix updated through Wednesday or just yesterday's close. And you can see the economy section is down here, not line 98 of the trends tab, and this is a breakdown of the economic activity composite. We're going to take a look at that in specific detail, and we're going to see where we stand in terms of the economy. And since there's such an important discussion about the economy and whether or not we're in a recession, a lot of people are denying that. It is important to tune out the internet and mainstream media, and actually most sources of information, because it just contains too much opinion. Whether the opinion is political or social or even personal, people have their own biases. And opinions are not very helpful. The only way you can parse through that is to study what the invisible hand is doing, which is essentially the collective conscious of the entire world acting in their own self-interest. And that's the only way I know how to do that, and we have learned to do that, is to program a computer to track this stuff independently of our own opinions and focus on trends that are in place according to a standardized set. We track what we call the EAC, which is either up or it's down. You can see it here. You can click on any of these links as you subscribe, and you can read a definition. You can talk about the help files here. But in general, there's two components of them. There's the ITCO and LTCO. We're going to take a look at that right now. I'll open that up on a separate database, and we're going to take a look at these components. I'm going to look at one here. I don't want to go into an extended discussion. That's why we have the ES, or the economy and stock reports, to do that. This is the economic activity composite for the United States, which then defines marginal economic activity as either up or down. If it's down, it's red. You can see the red box. If it's up, it's unshaded. And they are down here. These are the two lines. There's a fast line and there's a slow line. Currently, the fast line is clipping above zero a little bit, but the slow line is still down below, so we still have a red box. And that helps us define where we stand. We have we have contracting economic activity, and it's been going on for a while, even though nobody wants to admit it in the public space. It could get worse. This also follows an economic cycle in itself that we talk about more in the report. I don't want to pop in and show all the arrows and confuse things, and I don't want this to be too long. People don't process too much information, and we would like to keep this short. But for now, we're really in a down phase, but whether or not that phase, this red box, is either an up or down cycle, we talk about that more in the report. So really where we stand is in an economic contraction. I'm back to the matrix. And that is really defined here. You can see bearish economic activity is the main readout from the computer, and talks about other components of these trends here. But you have to get both of these above zero, and they're both down below, and that's where you have an economic contraction. That means the economy remains vulnerable, whether or not the politicians or anybody classifies this as a bearish backdrop or a bullish backdrop. It is irrelevant. It is still bearish, and it can get worse. And Path of least resistance when it's down tends to stay down, and bad things happen. Having bullish expectations economically when the trends are down is never a wise outcome. So the real question then stands is where do we stand? Has the Fed got things covered? Are we raising rates? Is getting inflation under control? We're going to address that here with the next pull out the next database. This is the inflation spread that's in place. So it's either highlighted green for a bullish spread or a bullish, and that's bullish for inflation. So that means higher inflation and inflation expectations being embedded in, or it's unshaded and then things are coming down, or you have disinflation. But we have a green box, so whatever the Fed's doing in terms of what it likes to state and how it likes to state things, it's not getting any better. So this has to come down below the dotted line, and we will talk about this before more. But the Fed really doesn't have control of things, and actually it is getting worse. And if we open up another database, you can see that the invisible hand is warning us of on numerous levels. Not only is the economic activity down and inflation spreads are widening, you're starting to see all sorts of spreads, and there's different types of spreads that we follow. These are the Treasury spreads. This is the 10-year with the T-bill spread, kind of like the Fed funds rate, and this is up to the 30-year. But problems usually start when you get a red highlighted box. That tells us that the yield curve is starting to invert, which is a warning. It's a warning that things are getting illiquid. And this is also confirmed in we can see it in other spreads. We talk about the quality spreads before. That's another measure. And there's also the spread between in the corporate quality spreads. And then there's a spread between the private and public sector. They're all rising, which warns that this backdrop, this environment is precarious. And when you have a declining economic activity, you have a stock market with primary trends across the board are still down, and then you have for the first time, and this is why we triggered this, we have a red box. Now this red box is a thin line that just started and it hasn't finalized. It's got to get finalized by the end of the month. But you can notice how big these red boxes are, and they go back a long time. I mean, you can see the red boxes that exist through numerous periods. The one lesson is when you start to get a red box like this, this magenta line, or the one that goes follow the cursor through here, that's the stock market. When you get this, a lot of bad things happen during that, or at least shorter term. Many times they show up before big declines. Of course, the stock market trades within its own cycle, so you need to define whether or not the stock market's in an up phase or a down phase, and that will determine whether or not this red box is even more dangerous. If it exists within a down phase, you can get severe declines in the stock market. If it exists within an up phase, they still come, but they're not as bad. And that's the kind of stuff that we're going to talk about. And we have talked about it in the report already, but we're not going to talk about it here because we're approaching the 10-minute mark, and that's where we wanted to kind of cut things off. So really, the spreads are starting to widen to the point where they're highlighting a warning. That means the liquidity is starting to show up. And when people start to talk about the economy is about ready to recover, it usually is the exact opposite. Now, whether or not the Fed has control of this, that's going to be something that's going to be debated heavily on the internet. We've already seen that the inflation indication, of which the Fed is primarily supposed to be held accountable for employment and inflation, yeah, they're not going to be doing real good at it because they are deteriorating. We showed that the inflation expectation has got a green box. Now the market, or the invisible hand, is saying you've got a problem here and it's getting worse. It's bad enough to create one of these inversions, and as these inversions go, usually the stock market drops. If I can come back, you can look inside some of these other indicators. This is the quality spread, and you can see that the quality spread is usually coming down over here, but now we're in the down phase. You can see that the down phase usually, which is unshaded, it's an unshaded region, it usually means things are improving a little bit shorter term. So it's not widely held across the board. But the fact is that the economy is in a down. The economy is showing a red box, which is it's turned lower, and we're contracting as some of the liquidity is drying up. It's not across the board, and it's not screaming, but it is getting pretty bad. And when it gets pretty bad, it raises the flags of which you better start paying attention, and you better start watching those reversals close, because if things drop you're going to see everything drop. And in this market with this much debt and this much leverage, when things start to drop, margins and calls start coming running and everything gets sold off. So we'll head back here one more time back to the matrix and we'll kind of wrap this up. I mean, we're going to the economy and stock report focuses on the economy and all related aspects of it and things that are not normally tracked with inside the matrix. And we try and translate that into the stock market, and we'll even expand it because the stock market doesn't trade all by itself either. If the stock market starts to sell off based off of liquidity and other concerns, it's going to affect all sorts of markets. That's going to include the commodity markets and the grain markets, of which people are saying, hey, those markets are unrelated, but they are related based on that they are all using the same instrument that denominates everything, and that's the dollar. And that brings in, another report, which is the dollar report. And everyone's probably wondering why the dollar is rallying. And trust me, it's all connected. Again, that's another important report to track as well. And I don't want to expand on it here too much. We want to focus on the economy and stock market. So this is where things stand in terms of how we look at and how we use the economy, how we look at spreads outside, their measures of liquidity, and things are starting to get to pick up. And the suggestion that 2023 is going to be a volatile and difficult year is not just a hint. I mean, it is setting up for that. As we turn the calendar over in 2022, some of these it's difficult to achieve. And I'm going to bring one more back. It is difficult to achieve a red box like this. That is a classic sign of strain. And you can see the strain exists and the stock market can continue to rally for several months into that before then it rolls over and turns over. So it's an initial heads up, and it's a heads up that warrants probably further discussion. So that's where we stand in terms of the economy and stock market and just the overall measures of liquidity that drive every market that's inside the matrix. And we just wanted to introduce some of this stuff, throw it out there that people can start participating. And I suspect and really suggest that the economy and stock market report is going to be a critical factor that we're going to be talking about a lot in 2023. We said this in 2021 about the dollar index, and that's come through, and I suspect 2023 is going to be a bumpy ride. It'll be a bumpy ride for those who don't understand what's taking place, and when that takes over, when the lack of understanding, fear comes into the equation. And a lot of times the best way to avoid fear is to understand, to step aside when the time is right. And the time is now to start having that discussion, and then you don't have to face the pain that exists when the majority starts to panic and they cry out to the Fed, save us. If you have any comments or questions, let us know. If not, thanks for watching today's video, and consider taking a look at the economy and stock report in the future.